There is a shadow fact that no one in the hallowed halls of Ottawa or the glass towers of Bay Street wants to whisper out loud. It is the reality that while your bank balance might stay the same, the actual value of your labor is being harvested like a crop in a late autumn frost. For decades, Canadians have been sold a specific version of the dream. Work hard, pay your taxes, and the system will provide a floor of stability. But as we look towards the next 5 years, that floor is not just creaking, it is disintegrating. We are entering a period of the Great Canadian Squeeze, where the cost of existing is decoupled from the value of earning. You feel it every time you tap your card at the grocery store, a visceral pang in your chest as the total climbs higher than the bag's weight. This isn't just a temporary spike in inflation. It is a fundamental shift in the Canadian social contract. By the end of this forecast, you will understand why the next half-decade will be the most transformative and potentially painful period in our nation's economic history. But before we look at the numbers, we have to look at the lie we've all been living. Let's talk about the golden handcuffs of the Canadian mortgage. For the last 20 years, housing has been the golden goose of the North. But as we head into 2025 and 2026, the goose is cooked. We are facing a multi-billion-dollar mortgage cliff, as hundreds of thousands of Canadians who locked in rock-bottom rates in 2020 are forced to renew at rates that would have seemed unthinkable just a few years ago. The pain is visceral. It's the sound of a young family in Brampton or Surrey sitting at their kitchen table, staring at an extra $1,800 a month in interest alone. This isn't just tightening the belt, it's the total liquidation of the middle-class lifestyle. The forecast for the next 5 years suggests that we are moving toward a permanent renter class, where the dream of a backyard in the GTA is replaced by the reality of a 500-square-foot box that costs 60% of your take-home pay. The Bank of Canada is walking a tightrope with no net, trying to fight inflation without triggering a total housing collapse. But here is the shadow fact. They might actually need the collapse to reset the deck. Are you prepared for your home to stop being an asset and start being a liability? The $2 trillion household debt bubble is the ticking time bomb in the Canadian basement. We have one of the highest debt-to-GDP ratios in the G7, and for years we've used our homes as personal ATMs to fund a lifestyle that our stagnant wages couldn't afford. But the ATM is out of service. Over the next 5 years, the wealth effect will reverse violently. As interest rates stay higher for longer to combat a sticky CPI, the discretionary spending that fuels our local economies will evaporate. Think about your local mall, your favorite restaurant, or the small business down the street. They rely on the middle class having a few extra $100 at the end of the month. When that money is redirected to servicing interest on a line of credit or a variable rate mortgage, the velocity of money slows to a crawl. We are forecasting a ghost economy, where people go through the motions of working, but the fruits of their labor are instantly siphoned off by the Big Five banks. The emotional toll of this debt is a silent epidemic, leading to burnout and a sense of hopelessness that is becoming the new Canadian norm. Why is no one talking about the structural insolvency of the average Canadian household? The immigration debate in Canada has shifted from a point of pride to a point of profound economic tension. Over the next 5 years, the disconnect between our population growth targets and our infrastructure capacity will reach a breaking point. We are inviting the world to a house that is already full, with a kitchen that hasn't been updated since the 1970s. This isn't about politics, it's about math. When you bring in 1 million people a year, but only build 200,000 homes, the laws of supply and demand dictate a brutal outcome for those at the bottom of the ladder. This pressure is felt most acutely in the rental markets of Toronto, Vancouver, and increasingly Calgary. We are seeing hot bedding and basement suites shared by 8 people becoming the standard, not the exception. The curiosity gap here is who actually benefits from this? It isn't the new immigrants who find themselves struggling in a high-cost environment, and it certainly isn't the existing middle class. The answer lies in the corporate demand for cheap labor to keep wage growth suppressed while the cost of living skyrockets. This demographic shift is a deliberate economic lever, but it's one that is being pulled until it snaps. Let's address the elephant in the room, the grocery oligopoly. In Canada, 3 companies control the vast majority of what you eat, and their profits have reached record highs, while the average Canadian skips meals to make rent. The Loblaws effect is more than just high prices. It is the realization that in a land of plenty, food security is becoming a luxury. Over the next 5 years, we expect to see continued consolidation in the retail space, further reducing competition. The visceral pain of paying $15 for a club pack of chicken or $8 for a head of lettuce is a daily reminder of our loss of purchasing power. The CRA takes its bite, the landlord takes theirs, and then the grocery giants take what's left. This is the triple squeeze. We are forecasting a rise in food desert mentalities and a massive surge in food bank usage among full-time professionals, people with degrees and office jobs who can no longer afford the basic calories required to function. When a G7 nation can no longer feed its workers affordably, the social fabric begins to fray. Is the Canadian grocery store the new front line of class warfare? The Bank of Canada and Tiff Macklem are trapped in a feedback loop of their own making. For years, they kept rates at near zero, fueling the very housing fire they are now trying to douse with a garden hose. As we look at the 2025-2029 window, the pivot everyone is praying for might be a mirage. If the BOC cuts rates too early, the Canadian dollar, the loonie, will tank against the US greenback, making every imported good, from iPhones to avocados, significantly more expensive. This is the currency trap. We are a nation that imports almost everything we consume, but exports raw resources. If our currency loses its punch, our standard of living drops instantly. The emotional pain of watching your global purchasing power evaporate while you work harder than ever is a unique kind of torture. The forecast shows a volatile CAD-USD relationship that will force Canadians to stay staycationing and buying domestic, but even domestic prices are tied to global energy costs. You are being boxed in by a monetary policy that prioritizes the stability of the banking system over the prosperity of the individual citizen. The CRA tax bite is becoming a legal form of wealth confiscation for the middle class. With the recent changes to capital gains and the bracket creep that fails to account for real-world inflation, the Canadian government is increasingly reliant on the productive class to fund a growing deficit. Over the next 5 years, we expect tax compliance to become even more aggressive as the federal debt interest payments balloon. It's a bitter pill to swallow. You pay 40 to 50% in marginal tax rates, only to wait 12 hours in an ER or months for a specialist. This is the value deficit. Canadians are paying for a Scandinavian-style social safety net, but receiving a crumbling infrastructure in return. The visceral feeling of seeing half your bonus or overtime pay vanish before it hits your account is driving a quiet quitting movement across the country. Why bother striving for the next promotion when the government is your primary beneficiary? This productivity crisis is the silent killer of the Canadian economy, and the forecast suggests it will only get worse as the best and brightest look for the exit. Canada is an energy superpower that behaves like an energy pauper. We sit on some of the largest oil and gas reserves on the planet, yet we struggle to build a single pipeline or export facility without decades of litigation. Over the next 5 years, the global energy transition will create a massive divide in the Canadian economy. The West will likely see a surge in demand for ethical Canadian energy, but the federal regulatory burden will act as a permanent handbrake. This missed opportunity is costing the average Canadian household thousands of dollars in potential wealth. Instead of an Alaska-style sovereign wealth fund, we have a mounting federal debt. The visceral pain here is the carbon tax, a policy that, regardless of its environmental intent, acts as a regressive tax on a population that lives in a cold, vast geography. The forecast shows energy costs becoming a primary driver of poverty in rural Canada, where heating your home in January becomes a choice between warmth and nutrition. Why is Canada the only resource-rich nation that seems intent on keeping its resources in the ground, while its citizens freeze? The productivity gap between Canada and the United States is no longer a gap, it is a canyon. Our southern neighbors are innovating in AI, space tech, and biotech, while the Canadian economy has become a game of trading houses with each other. We have stopped investing in machinery, technology, and business processes, opting instead to park our capital in unproductive real estate assets. Over the next 5 years, this will manifest as a standard of living crash. When a country stops being productive, its currency eventually reflects that reality. We are forecasting a future where the average American is 40% to 50% wealthier than the average Canadian, a disparity not seen in our lifetimes. This leads to the brain drain 2.0, where our top engineers, doctors, and entrepreneurs flee to the US for higher pay and lower costs. The emotional pain of watching our best talent leave because they can't afford a home in the city they grew up in is a national tragedy. We are becoming a branch plant economy, dependent on the crumbs of global capital, while our own innovation engine sits idle. The TFSA and RRSP are being marketed as the keys to your freedom, but for many, they are becoming an inflation trap. If you are saving in a currency that is losing 5% to 10% of its real-world purchasing power annually, but your investments are only returning 6%, you are effectively standing still while the treadmill moves backward. Over the next 5 years, the traditional 60-40 portfolio will likely fail the average Canadian. We are entering an era where safe investments are the most dangerous. The shadow fact is that the government needs inflation to burn off its massive debt, which means your savings are the fuel for that fire. The visceral fear of reaching 65 and realizing your $1,000,000 nest egg only buys what $200,000 buys today is a nightmare scenario that is becoming a mathematical certainty. The forecast suggests that only those who pivot to hard assets or global equities will survive the debasement of the loonie. Are you actually building wealth, or are you just accumulating increasingly worthless paper? The next 5 years will demand a total rethink of what it means to be financially literate in Canada. Year 1 of our forecast, 2025, will be defined by the mortgage reset shockwave. This is the year the theoretical pain becomes literal for the majority of the suburban middle class. We expect a surge in forced listings as homeowners realize they cannot bridge the gap between their old 2% rate and the new 6% reality. This won't be a sudden crash like 2008 in the US, but a slow grind lower. The psychological impact will be profound. For the first time in a generation, the housing always goes up mantra will be silenced. We will see a shift in consumer behavior. The luxury segments of the economy, new cars, high-end travel, and renovations will crater. The curiosity gap here is who is waiting in the wings to buy these assets? It's not the first-time buyers. It's the institutional investors and REITs with deep pockets, waiting to turn Canada into a nation of permanent tenants. The corporatization of the Canadian neighborhood begins in earnest this year. Are you watching the signs, or are you waiting for the headlines to tell you what's already happened? By year 2, 2026, the labor market lag will catch up to the economy. Historically, unemployment is the last thing to break, but when it does, it breaks hard. We are forecasting a significant uptick in white-collar layoffs as corporations look to trim the fat in a high-interest rate environment. The safe government job might not be as safe as it once was, as provincial budgets groan under the weight of healthcare and education costs. The visceral pain of career-level unemployment in a high-cost country like Canada is devastating. There is no cheap place to hide anymore. Even the small towns have been bid up by remote workers. This year will be the year of the side hustle, not out of ambition, but out of survival. The gap between those with multiple streams of income and those reliant on a single T4 slip will become an unbridgeable chasm. The emotional stress of the Sunday scaries will transform into a permanent state of anxiety for millions of Canadian workers. Is your skill set truly recession-proof, or are you just next on the spreadsheet? In year 3, 2027, the healthcare breaking point will become the primary economic driver. As the boomer generation enters their peak healthcare consumption years, the cracks in the single-payer system will become canyons. We are forecasting a massive, unacknowledged shift toward a two-tier system. Those with money will medical tourist their way to the US or private clinics, while the middle class languishes on wait lists. The economic cost of a sick population is astronomical. Lost productivity, caregiver burnout, and the hidden tax of private insurance premiums will eat further into household budgets. The visceral pain of seeing a loved one suffer because the system is out of capacity is the ultimate betrayal of the Canadian promise. This year, we expect the political discourse to turn toxic as the reality of unfunded liabilities hits the front page. The shadow fact is that the government has made promises it physically cannot keep without inflating the currency into oblivion. Are you prepared to pay for your own survival in a system you've already paid for through taxes? Year 4, 2028, will likely see the introduction or the aggressive push for a digital loonie, or central bank digital currency, CBDC. As the traditional banking system struggles with the weight of bad debts, the government will pitch the CBDC as a tool for efficiency and inclusion. But the curiosity gap is much darker. It's about control. A digital currency allows for programmable money, taxation at the source, expiration dates on stimulus, and the ability to track every single loonie spent at a local pub or a protest. The visceral fear of financial surveillance will drive a segment of the population toward alternative assets, like Bitcoin or physical gold. This year will be a financial civil war between the state's desire for order and the individual's desire for privacy. The forecast shows a fragmented economy where a gray market of cash and barter thrives in the shadows of the digital grid. How much of your freedom are you willing to trade for the convenience of a government-backed app? The 5-year window is where the digital cage is built. By year 5, 2029, the new Canada will be fully formed. It will be a nation of extremes. On one side, an ultra-wealthy tier of asset owners and global elites who have hedged against the loonie's decline. On the other, a vast neo-peasantry of renters and gig workers who live paychecks to paycheck, regardless of their education or title. The middle class, as we knew it in the 1990s, will be a historical footnote. This is the culmination of the 5-year forecast, the total stratification of Canadian society. The emotional pain of this realization, that the Canada your parents lived in is gone, will lead to a profound national identity crisis. But within this chaos, there is opportunity for the few who saw it coming. The curiosity gap is, will you be an asset owner or an asset managed? Those who spent the last 5 years deleveraging, diversifying into global markets, and acquiring hard assets will be the new middle class of the 2030s. The rest will be left wondering how a country so rich in resources could leave its people so poor. This is the end of the forecast, but the beginning of the new reality. The side hustle culture in Canada has been romanticized as entrepreneurial spirit, but the visceral reality is much bleaker. It is a symptom of a failing primary income. Over the next 5 years, we will see the death of the 9-to-5 as companies move toward contract-based, just-in-time labor to avoid paying benefits and pensions. This gigification of the Canadian workforce means that your income will become as volatile as the price of gas. The emotional toll of never knowing if you'll have enough work next month is creating a mental health crisis that no one is counting in the GDP. The curiosity gap here is, how does a society function when no one can plan more than 30 days ahead? You can't get a mortgage with a gig income. You can't build a family on contracts. We are forecasting a demographic winter as young Canadians delay or cancel plans for children because the economic soil is too thin to support new life. The very foundation of our future, the next generation, is being sacrificed to maintain the current system's liquidity. The intergenerational wealth gap is the new Great Divide. In the next 5 years, we will see the largest transfer of wealth in Canadian history as the boomers pass on their primary residences, their tax-free windfalls, to their children. But there's a catch. The great inheritance will be unevenly distributed, creating a landlord class and a serf class based entirely on who your parents are. If your parents didn't buy a house in the 80s, you are effectively locked out of the Canadian dream forever. This lotto birth economy is the antithesis of the meritocracy we were promised. The visceral feeling of resentment among Gen Z and millennials is reaching a boiling point. The curiosity gap. What happens to social stability when hard work no longer correlates with success? The forecast suggests a rise in populist movements that will target the primary residence capital gains exemption, the holy grail of Canadian politics. The battle for the remaining crumbs of the Canadian pie is about to get very ugly, very fast. Are you positioned to inherit, or are you positioned to be taxed to pay for someone else's inheritance? The silent solution that the top 1% are currently executing is the capital flight from Canada. While the average person is worried about the price of eggs, the wealthy are moving their liquid capital into US-denominated assets, Bitcoin, and offshore jurisdictions. They see the writing on the wall, a declining currency, rising taxes, and a stagnant economy. The visceral pain for the rest of us is that we are trapped in the loonie. We are the ones who will pay for the deficits through our debased purchasing power. The curiosity gap. Why is the government making it harder to move money out of the country? Because they know the exits are being crowded. The next 5 years will see financial border controls become a reality, not in the sense of guards, but in the sense of exit taxes and wealth taxes designed to keep the remaining capital within the CRA's reach. If you don't have a financial escape plan that involves diversifying out of the Canadian dollar, you are the one who will be left holding the bag for the national debt. The forecast is clear. The walls are closing in on the Canadian saver. Let's look at the tech AI revolution through a Canadian lens. While we have brilliant minds in Toronto and Montreal, we lack this scale capital to keep them here. Over the next 5 years, AI will automate the very middle management jobs that are the backbone of the Canadian suburbs. The visceral fear of being replaced by a script written in Palo Alto is real. Canada's economy is heavily weighted towards service and administration, the two sectors most vulnerable to AI disruption. Our forecast shows a displaced class of professionals who thought they were safe. The curiosity gap: will the government introduce a universal basic income, UBI, to keep the peace? All signs point to yes. But UBI is the ultimate shadow fact. It's not a gift. It's a floor of poverty that ensures you can pay your rent to the corporate landlords and buy your food from the oligopolies, but never, ever escape the system. It is the subscription model for human existence. Are you ready to be a subscriber to your own life? The CPP stability question is the ghost that haunts every Canadian over the age of 50. We are told the Canada Pension Plan is solvent for the next 75 years, but that solvency is based on economic growth assumptions that look increasingly delusional. In the next 5 years, as the dependency ratio shifts, more retirees, fewer workers, the pressure to increase CPP contributions will be relentless. This is a tax by another name. The visceral reality is that you are paying more today for a benefit that will buy significantly less in 30 years. The curiosity gap: why are provincial governments like Alberta talking about leaving the CPP? Because they see the ship is taking on water. The forecast suggests a pension war, where provinces fight over the remaining pool of capital. The emotional stress of realizing your retirement security is a political football is enough to keep anyone up at night. The only true pension is the one you build yourself, outside of the government's reach. Are you counting on a promise, or are you counting on your own assets? The final warning is the demographic collapse that is no longer in the future. It is here. Canada has one of the lowest birth rates in the developed world, masked only by record-high immigration. But you cannot import a social fabric or import the 20 years of productivity a child takes to develop. Over the next 5 years, the caregiver crisis will peak. The middle class will be torn between working 50 hours a week to pay a mortgage and caring for aging parents in a failing healthcare system. The visceral feeling of suffocation is the best way to describe the next 5 years for the 35 to 55-year-old demographic. You are the squeeze generation. The curiosity gap: what happens when the immigration engine slows down because Canada is no longer an attractive destination? If the Canadian dream becomes a Canadian nightmare of high costs and low opportunity, the world's talent will go elsewhere. We are forecasting a stagnation trap, where we have the costs of a first world nation and the growth of a third world nation. The point of no return is closer than you think. Have you checked the exit signs lately? This 5-year forecast isn't meant to scare you. It's meant to wake you up. The shadow fact is that the system is working exactly as intended. It's just not intended for you. The next 5 years will be a great sorting. Those who remain passive, who trust the headlines, and who stay locked in the loonie will be the casualties of this economic shift. But those who recognize the triple squeeze and the currency trap can still thrive. The curiosity gap we leave you with is this: when the digital loonie arrives and the housing reset is complete, which side of the wall will you be on? The survival guide for the next 5 years is simple but difficult. Reduce your dependence on the Canadian system, diversify your assets globally, and invest in your own hard skills. The Canadian dream isn't dead, but it has changed its address. It no longer lives in a white picket fence suburb. It lives in the mind of the individual who refuses to be a victim of the forecast. The question isn't what will happen to Canada. The question is, what will you do to make sure you are the one who survives it?